Greetings, everyone. Happy New Year, 2023. Well, if you had told me that oil prices would be cut by nearly half from their peak last year and that interest rates would be down into the mid threes from 4.25 at their peak last year in terms of the long-term Treasury yield, I would have told you that growth stocks would have had a wonderful end to the year. And of course, that did not happen. It did not happen because it seems as though investors are waiting for permission from the Fed. So let's go through, as we usually do, fiscal policy, monetary policy, economic indicators, market indicators and signals, and then spend a little more than normal time on innovation, not what is to come, but what happened last year in terms of breakthroughs in innovation, truly disruptive innovation. And it seems like the market's ignoring those as well, which is okay because we feel truth wins out. But we'd like to share with you some very interesting and in some cases mind-blowing developments from last year. So let's start on fiscal policy. We are in the middle of gridlock already. I guess the House can't figure out who the speaker is going to be. Gives you a sense of gridlock, which we'll probably experience until the next national election, roughly 2 years from now. So the good news there is there probably will not be profligate spending, which from our point of view ultimately turns into one kind of tax or another, either outright taxes or inflation, which is accrual tax, or debt, which is a tax on future generations. So that's the good news. Even better news would be bipartisanship. It's hard to believe it's possible. We are hearing more members of Congress, that is, talking about their desire for bipartisanship. So hopefully steps in the right direction at some point to get our government working again. So fiscal policy, the only other thing I'll say about this is we did get what the so-called Inflation Reduction Act last year. It was $1.7 trillion. And I was surprised that it did get through, but it did. And now everyone's heralding it as bipartisanship, which again seems to be becoming a buzzword because the electorate wants it. Of course, the bears on inflation and on the market are seizing that, running with it and saying, this is inflationary, this is inflationary. As I described, inflation can come in many forms. And as I'll describe later, we do not believe that it is going to cause inflation going forward. After all, it's called the Inflation Reduction Act. We don't believe that either, but we do believe that inflation is coming down for other reasons. One of the things that happened in the last 3 months was the COLA adjustment, the cost of living adjustment for Social Security, or it was within the last 6 months. And that was 8.7%. It's based on the CPI. That many people are pointing to as a possible inflation or possibly aggravating inflation. Well, the COLA for Social Security is for retirees. They tend not to be big spenders. It does provide them for some relief from the food and energy price inflation that we've seen. At least they're perhaps able to replenish a bit. But in terms of inflation itself, let's talk about monetary policy. So M2 is now down to zero growth on a year-over-year basis, and that's as of November. It does look like November went negative, and we believe the negative growth rate will continue, if not accelerate to the downside during the next 3 to 6 months. This is a very unusual period. In fact, in my career, I've never seen it go negative, and I've been in the business for nearly 45 years. So this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. So it's very interesting to hear the Larry Summers of the world hearkening back to the 70s in terms of expectations for inflation. He's ignoring a lot of real-time indicators, a lot of market indicators, and we'll spend a lot of time on that in a minute. Now, when I say uncharted territory, if you look at the average money supply growth for the last 25 years and the last 50 years, a very long time, the average money growth has been 7% at a compound annual rate. So, zero negative is a huge departure, and we believe highly deflationary. And we're beginning to see that as I will illustrate as we get into the market indicators. The Fed funds rate went to 4.5% in December, and it does appear that the Fed is determined to take it up again. They want nothing to do with a legacy associated with inflation. And as we've suspected for some time, they are unanimous because there are people like Larry Summers out there saying, you're going to be responsible for another run at 70s style inflation, which was highly destructive. And many times I've mentioned here that the 70s inflation is nothing like the inflation we just experienced. The 70s inflation started in the mid-60s with the Vietnam War, with the Great Society programs, one after another, and then we went off the gold exchange standard and lost all discipline. That's nothing like what we've been through. We have been through a massive supply shock, two of them, COVID-related, and then the Russia invasion of Ukraine. Very different circumstance. One led to lasting inflation, and this one, we believe, as I've mentioned many times before, will be much like what we saw in the early 1920s after a pandemic and World War I. Inflation collapsed. It actually ended up at negative 15% in June of 1921. And we do believe this year we're going to drop below 2%. And in fact, the bond market believes it. The bond market's break-even rate is 2% for the next 10 years. In other words, the bond market is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. And in fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now, we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. And the stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008, and we believe are in secular decline. And we'll get into that in a moment. On February 1st, we'll probably see another 25 or 50 basis points, so we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices that we have begun to see. And again, we'll go into that in a moment. One other thing to note about monetary policy, it's very influenced these days by Keynesian economics. and something called the Phillips curve. Phillips curve basically suggests that if employment is strong, then that will lead to inflation. The history of the last 40 years, however, is the opposite. Employment was pretty strong when you adjust out for recessions, pretty strong for the last 40 years, and yet inflation and interest rates came down quite a bit from mid-teens in the early 80s to 0.5% during COVID. So that the history of the last 40 years does not support the Phillips curve, and yet it is interesting to listen to the Fed say, oh, wow, employment, we got to get it down, otherwise wages are just going to take off and become embedded in the system. That was the 70s experience, but it has not been the experience since then. And we do not believe we're in anything like that environment, as I just mentioned. And now the reason it's wrong is when employment is increasing, employment and output are increasing. If they're increasing in a healthy way, then productivity is increasing as well. And we've had a lot of dislocations associated with supply chains recently. So it's very hard to tell where we're going to settle out in terms of productivity. But we do believe, if we're right on how much innovation is taking place, that productivity is going to start scaling in a surprising way and take the sting out of inflation fears completely. So just wanted to share that with you. Now on to economic indicators. I'll go quickly through this part. We did get the employment report today, and it had something for everyone. For those who think the economy is booming, the unemployment rate dropped from 3.7%, which was revised to 3.6, to 3.5, so back to the cycle lows. Non-farm payroll employment looked stronger than expected. I think 223,200 was expected, but previous months were revised down. So that was interesting. The other measure of employment that I've mentioned on this video a number of times is the household measure of employment. Now, it had been falling on balance since March of last year. And in December, there was a big burst, 781,000. Now, this incorporates more small businesses into the survey. So 1 month does not a trend make. It does not erase at all the gap between non-farm payroll employment and household employment that has built up since last March. There's a 2 million person gap. So the truth is probably somewhere in between. Average hourly earnings came in lower than expected, 0.3. Expectation was 0.4. And more important was the previous month, which caused such consternation in the markets, was revised from 0.6 to 0.4. And then we had this drop off to 0.3. Now, part of this is a function of mix shifts. You're seeing a lot of high-profile layoffs in the technology industry. Those are high-paying jobs. You're seeing a lot of the employment growth that we're seeing right now in the leisure and hospitality sector. That's lower. Those are lower paying jobs. So there is a little bit of mix shift at work here. On a year-over-year basis, the rate is now 4.6%. Last month, we thought it was 5.1. Turns out, I believe it was 4.8% after the revision. So again, at turning points in all kinds of cycles, whether it's activity or inflation, we get a lot of revisions. Most important to me in this report, besides the fact that there was that pop in household, so employment isn't falling off a cliff, but the work week did fall 0.3%. And that is going to have an impact on incomes. It looks like personal income or personal disposable income will be up only 0.1% month to month when you take all these factors into account. That's not very much. We had better hope that inflation continues to slow. Most of the inflation indicators we've gotten in the last 2 months have been better than expected. And the Fed's beginning to mention that, but isn't buying into it yet. So we're in a period, we think, where average hourly earnings on a year-over-year basis are still falling in the 2.5% to 3% range in real terms, taking account of inflation. We also got another number today, ISM for the service sector. It's an index that it's a diffusion index where anything below 50% suggests that the economy is contracting. And the most important number in that report was orders, always is. Orders dropped 10 percentage points, very sudden and very rare for this index. And as you know, services are a much bigger part of the economy than manufacturing. So that drop off in orders is reminiscent of what we saw during 08-09, and not at all what we saw during the COVID crisis. So much worse than that. And I think we're probably in response to that going to see more layoffs in the service sector, and probably some of these employment metrics turning a little bit more negative. The orders number corroborates what we saw from factory orders for the month of November. They were down 1.8%, and even more important, the previous month was revised down from plus 1% to plus 4%. So again, at turning points, we look at revisions. And while we think that when history is said and done, the recession started at toward the beginning of this past year, most statistics are still conflicting. And so that's why I'm saying at turning points. The other notable stats we got include the trade balance. Now, GDP has been stronger than expected. One of the major reasons for it is a collapse in imports relative to exports. So imports subtract from GDP. So if their imports dropped 8%, so if you subtract that, you're really adding to GDP. What is this saying? This is saying that we are cutting back on inventories. Much of them coming from China. I think in the import report, consumer was the biggest fall off, and that would be associated with China. Exports fell, but not as much as imports, and therefore the trade balance improved, and that's going to help economic activity. But it's not for a very good reason. If you think about this, exports down 8%. That's not year over year. That's month to month. You know, that's like 100% annualized percent decline, almost. Well, that's an exaggeration, but almost. So that's a very big drop and a big hit to China and other economies, I would suggest. Another curious report in this last month is consumer credit, consumer installment credit. Now, I've mentioned this also before. We're seeing huge increases in consumer installment credit, the net change, 25 billion plus. Now, this is very unusual, except during periods when consumers are stretching. Consumer saving rate has dropped to 2.3%. It's very low by historical standards. It doesn't go much lower. And so what is the consumer doing? It is that the consumer is buying more necessities, probably on credit cards, on installment. And that will continue to drive the saving rate down. So the saving rate is simply disposable personal income, which I just mentioned is diminishing in terms of its growth rate quite significantly, minus consumption. And so goods bought on debt subtract from savings. We got some bad sales indicators in the month. Retail sales down 0.6% for the month of November, going into the holiday season. We got some reports. We'll see what happens when the numbers are completely tallied, but it looks like online spending might have been down, negative. Certain categories certainly were down, and that'll be a first in the history of online. So the real average hourly earnings dropping on a year-over-year basis is having an impact. Housing is also not showing any let-up. The only relief was in new home sales, up 5.8% month to month. But I'm sure that a lot of builders facing higher interest rates do not want to carry these homes anymore, particularly if they're spec homes. So they're pushing them out, perhaps with lower prices. But pending home sales are down 38% on a year-over-year basis. Now, in terms of market indicators, some very interesting ones. Let's start with equities and let's summarize the year. If you owned energy, which was up 59% last year in the equity market, you did very well. And as you know, we don't own energy. In fact, we're very negative on energy, certainly from a secular point of view. And now I would submit a cyclical point of view. Prices peaked in March at 130. They're down to 74, West Texas Intermediate. And yet the sector indices for energy sector index is reaching for its all-time highs. And if I look at this chart and from a long-term point of view, what I am seeing is a triple top in 08, in I think it was 2015, and now in 22. I'd be very surprised if it gets to a new high because the fundamentals are deteriorating. Demand destruction is real. China, some of the numbers that have been coming out of China are astoundingly weak. And of course, zero COVID is a reason for that. But I do believe China's been building inventories. And the reason it has been doing so is it's using the Russian war. It is buying oil from Russia at significant discounts. And we don't know how long this window will be open. The discounts reports are in the 30 to 40% range. So we would not be surprised to see inventories much higher almost everywhere in the world because of the war in Ukraine and the fears about not getting energy supplies, and China and India buying disproportionate amounts of oil from Russia. Russia doesn't have very many other places of size to sell that oil. Now, in terms of demand destruction, something interesting is happening here in the United States and probably elsewhere in the world. Many of you may have had this same experience. I was in California for the holidays, and I was taking Ubers. 3 Uber drivers were in Tesla cars, and I was asking them about Tesla. I found that curious. And they said, oh, yeah, we're renting our cars from Hertz. Hertz is now not charging us as much to buy or to rent a Tesla. And of course, that's the preferred car. And later on, we learned from Hertz that Hertz is doing this because it has learned that maintenance costs for a Tesla, and I'm sure other electric vehicles, are 50 to 60% below maintenance costs for gas-powered vehicles. Now, the reason this is important is because of a metric we monitor called electric miles traveled. Now, Uber drivers are going to travel many more minutes of the day or hours of the day than we are in our personal cars, which we just park and leave as we go to work. So what this means is the number of electric vehicle miles traveled is starting to increase much more rapidly because of this Uber phenomenon, and sooner even than we might have expected. It is also very interesting to note that oil demand seems to have peaked in 2019. There has been a lot of demand destruction based on rising prices around the world. And so it'll be nip and tuck to see if we meet that 2019 number again. I think it was, let me see, I have it here somewhere. I think it was on the order of, 100.5 million barrels per day. Now, if we're right, and I'll get into this in a moment, that number is going to drop precipitously because of autonomous electric cars. And I'll talk more about that in the innovation section. And so we believe that this notion of peak oil, which we used to, when we used that expression in the day, it was all around peak supply. We're running out of oil. Nowadays, the phrase considered more often, I would say, is peak demand. And we do believe that we're in the process of peaking out in terms of oil demand. At the same time, here in the US, we are moving toward record oil production. And once again, this year, we believe we could be the largest oil producer in the world. So again, supply versus demand makes a price. Back to equities, just one other note there. If you owned technology, consumer discretionary, or consumer services being FANG-like, the last year was horrendous. Anything in innovation was horrendous. And what I'm going to be elucidating in a moment is how much actually happened on the innovation front last year. It was pretty astonishing, and the market just ignored it completely. Now, there are different reasons for these declines. For consumer services, of course, we have the Facebooks and the Netflix being disrupted. TikTok's a big disruptor. They're also now much more hostage to the cycle. Advertising is one of the first line items cut during a recession. And this is why we think we started in a recession early last year, because advertising fell off a cliff. And that is at least a coincident indicator, if not a leading indicator. So they're being disrupted. Now, in other innovation portfolios, true innovation portfolios, the new innovation, those stocks had a very bad year for a different reason. They're not being disrupted. In fact, they are more often than not the disruptors. They were penalized because they're investing aggressively now. And they are doing so because the opportunities associated with the 5 major innovation platforms around which we've centered our research. So once again, multi-omics sequencing, robotics, energy storage, artificial intelligence, and blockchain technologies, they are ready for prime time. They are taking off, as I'm going to describe to you in a moment. But the winners are going to be those companies that are spending aggressively now, especially because with artificial intelligence, many winners are going to be in winner-take-most categories. So we want that. But when the market is focused on one quarter and wants its profits now and its dividends now, And the algorithms basically decide that anything without high profit margins or anything that disappoints on profit margins because of more investing, algorithms, they make none of these distinctions and they just pummel these sorts of stocks. Truth will win out. This reminds me very much of the late 90s for value investors. In the late 90s, value investors looked like they had two left feet, looked like they had gone dumb, stupid. And of course, that was the tech and telecom bubble that ended badly. And they were right after all. Today, innovation investors look like they have two left feet or that they've lost their brains. But we are more convinced than ever that these innovation platforms are evolving maybe faster than even we expected. And we believe staying away from innovation now is going to be as big a mistake as falling all over other investors to try and up technology weightings in the late 90s. Again, truth wins out. On to commodity prices in terms of price signals. I'd like to focus on a number of commodities. I have the list here, and let me find them. But I'll start with a focus on oil. So oil price, the oil price topped out at 130 in March, early March of this year, right after Russia invaded Ukraine. It is now down it's down 40%. And more importantly, it's now down on a year-over-year basis, which again, this is what upset the market so much, is that energy prices were soaring, and on a year-over-year basis, we're up 50%. Now we're down, and we're down 40% from the peak. Other commodities, lumber's down 69% year-over-year. The Baltic Freight Dry Index, which is kind of a measure of supply chain tightness, is down 56%. Copper is down 13% year-over-year. And we do have a few that are flat to up slightly: gold, silver, and corn. But even they have come down significantly, roughly 20% for corn and silver from their peaks, and gold down more than 10%. So a lot of inflation indicators, real-time indicators, are saying we don't have an inflation problem. The reason I wanted to focus on oil is many people are expecting oil to shoot back up. I see forecasts for 140, 130, going to the last high because of China and China coming back now that they have stopped the lockdown policy. The strategic petroleum reserve here in the United States needing to be refilled, and OPEC cutting back, wanting to stabilize prices. Well, it's interesting that all of these things are true, and yet the oil price can't get going here. And I do believe inventories are a part of the problem. They're probably brimming. And another thing's going to happen here. I mentioned Uber and Tesla, so the demand shifting towards electric and away from fossil fuels, gas-powered. And that is another reason that used car prices are falling. They're down 14% year over year. And we believe that the residual value of these cars is going to collapse if we're right and the consumer preference shift towards electric, especially by Hertz. So that's a business preference shift, continues. And then the last price signal Bitcoin. It's been incredibly stable after the FTX related fall off last year. And by many of our metrics, and we will be putting out the Bitcoin Monthly early next week, by many of our metrics, there is outright capitulation all over the place. David Puel, who is our on-chain analytics expert, has a lot of capitulation metrics, and I think every one of them is where it has always bottomed before a turn. Now, we do have the digital currency group drama around Genesis, so we're watching that, and that probably, my guess would be the last shoe to drop if it drops, if they're unable to find their way out of this liquidity crisis. But in the face of that uncertainty, it is very interesting to see the Bitcoin price, for example, more stable in the last quarter than equities and bonds. And I think the other thing to note from bonds, if you adjust bonds for inflation, we have never seen a bigger rout. You have to go back to the 1700s to see a bigger rout than we've just been through. Okay, on to innovation, which is what ARK is all about. And we wanted to share some of the facts and figures having to do with 2022. So not even forward looking. We are looking at last year. And we'll start with crypto then. We did get, throughout the year, incredible turmoil around Luna, Terra, Celsius, 3AC, FTX, and so forth, and a really big black eye. But if you look at what caused the black eye, it was not Bitcoin or Ethereum. Those blockchains didn't skip a beat, didn't miss one transaction. And what we saw were the centralized entities touching crypto, FTX, 3AC, Celsius, other hedge funds, imploding. Why? They're centralized, not transparent, and there's no liquidity in them. Whereas if you look at what happened on Ethereum, the smart contracts, as trouble was looming, smart contract related margin calls, they were satisfied. Boom, boom, boom. No questions asked, no legal haggles. It just worked. And I think that will be the lesson coming out of this. And it is very interesting to note that Sam Bankman-Fried didn't like Bitcoin. And he didn't like it, I may have said this last month, he didn't like it because it's decentralized, fully transparent, and he couldn't control it. He considered himself the master of the crypto universe, which, of course, the market has disabused him and others of. One of the reasons I wanted to feature some things that have happened around innovation last year is because investors aren't taking note. And it is pretty astonishing. If we were in a bull market for growth stocks, innovation portfolios would be soaring on the type of news that I'm about to give you. I tweeted about the first one here. A 12-year-old girl, Alyssa, in the UK at a cancer research hospital, had tried dozens of therapies, maybe up to 100 therapies, and there was nowhere else to go. So they used base editing on her particular kind of leukemia. And 7 months later, she's cancer-free. Now, that happened, and we are in early days of base editing and other kinds of gene editing like CRISPR gene editing. But here's another example of a functional cure. And if any of you have seen the clip on BBC, I didn't see it on American television. I was in Asia and called back and said, oh, wow, isn't this exciting? And nobody knew what I was talking about. But when they did the research, and I just felt, okay, this is a real clue that the market's not discounting any innovation. In fact, worse, it's not even giving companies credit for innovation that is proving out, that's not in the future. So that was pretty interesting. And we also have, I think, 75 patients. These are CRISPR Therapeutics and Vertex patients in sickle cell disease. I think it's more than 75 patients when you include sickle cell disease and beta thalassemia cured. These are human trials, but that first man that we're keeping our eyes on, the beta thalassemia patient who used to go to the hospital 17 times a year for blood transfusions, I think he's hit on 2 years now and has not had a blood transfusion. So functional cures has happened. This is not on the come. Artificial intelligence, the breakthroughs here are absolutely mind-blowing. Check out ChatGPT. This is a derivative, I believe, of GPT-3 and OpenAI service. And what you can do is prompt ChatGPT to write an essay on the history of space exploration. And boom, less than a minute, it's there. And it's pretty well written too, and I'm a stickler on writing. Now, many people are horrified at this thought and what it means for education, but we're not, because the reason it's able to do this is it scours the internet from the beginning of internet time and writes the essay. Well, guess what? Yes, the internet includes a lot of facts and figures, but it also includes misinformation as well as creative writing and science fiction. So the history of space exploration is going to have all kinds of mistakes associated with misinformation or creativity. And so it's going to change education. There'll be a lot more fact checking if a student decides to have ChatGPT write an essay. But we already know that ChatGPT is scoring better than the national average on the SATs. And it's going to get better with time because these machine programs learn with time. There's another app that's out there called Lensa AI, put out by Stable Diffusion. And within, I think it was in 5 days, it got 1 million users. This app creates many profile pictures for anyone, just based on searching your Facebook and other social presence. So Brett Winton, our director of research, did it, and I must say that the photos look terrific. So he's now using one for his profile picture. We also have DALL-E 2. DALL-E 2 is, again, with a prompt. You can say, I'd like to see pictures of myself in all kinds of sports forms. And boom, 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 populated very, very quickly. And by our estimates, some of its output today, and it's going to get better, would probably cost $150 to $300 and take 4 hours or more for an artist to draw. And this took, just a few minutes. So, these are already, what we believe is going to happen is that artificial intelligence is the equivalent of the assembly line for the Industrial Revolution. But this is the knowledge revolution. And try these out yourself. You'll see how powerful they are. And we're hearing programmers say that, that you have to know how to program if you're going to do this, but it saves them 50% of their time. So it's really astonishing what's going on. some of the other examples out there. Connected TV. Many people seem to think that TV has, gone out of style, that everybody's just on mobile phones. And yet connected TV advertising did very well last year, in a terrible year for advertising. So linear TV advertising was down 2% last year. Connected TV advertising was up 14% last year. This is what usually happens during a period of disruptive innovation. The winner, the disruptor, usually takes massive share in a down market. And talk about down market. Connected TV has been hostage to the scatter market, which is the most discretionary ad bucket. It was down 38% in the third quarter last year. And connected TV advertising was up well into the double digits. Social commerce is taking share from e-commerce. So e-commerce was the disruptor, and now social commerce is taking share. We measure a lot of social commerce via Shopify, which is the back end for Instagram and Facebook and other sites that are selling goods in app. It's GMV, gross merchandise sales, effectively, volume. If you compare it to pre-COVID, third quarter of 2019, up 312%. If you look at e-commerce, which gained share during COVID, it is up only 86%. And as I mentioned, there are some surveys out there saying that e-commerce, traditional e-commerce, was negative. Electric vehicle sales last year, up 49% in the United States, versus total auto sales down 8%. Disruptive innovation gained share during tumultuous times. Autonomous mobility, cruise automation is in San Francisco. Tasha and I took rides in Cruise Automation's cars in San Francisco in November, December. For me, it was seamless. I know Tasha's paying more attention to every single detail, but I thought it was a marvelous ride. And now they're entering Austin and Phoenix. It took them 9 years to perfect San Francisco. It took them 90 days to move into Austin and Phoenix. And they did that by the end of last year. In space exploration, the Falcon X, so SpaceX, has enjoyed or delivered 61 launches this year. That was up 96% in 1 year. That was last year. This is not on the come. And one of the reasons for SpaceX's success, and the reason we're going to get to Mars at some point, is reusable rockets. They were able to reuse their last rocket within 21 days. When they first started, it took 1 year to refurbish the rocket. So amazing progress, amazing progress there. And then on energy. Now, autonomous mobility, I mentioned, I queued this up a little while ago. If we are right, there will be real oil demand destruction caused by autonomous mobility. And here we're just measuring autonomous taxi platforms. We're not even measuring drones for parcels and food delivery, or eVTOLs, electric vehicle takeoff and landing, air taxis, in other words. We're not counting those. But if we're right, by 2030, oil demand will drop from about 100 million barrels today to somewhere between 70 and 75 million. Now, prices of any commodity are determined at the margin. Is the marginal demand increasing or decreasing relative to supply? And we believe supply is going up here after the burst in prices. It's invited a lot of activity, incentivized a lot of activity. And we believe demand is peaking. If it hasn't already peaked out, it's peaking out. and that the decline will be rather swift. It's been very interesting to watch the business or the financial market TV shows and listen to one portfolio manager after another say one of their favorite stocks is in the energy sector. And maybe energy will continue to perform. I don't know why, but maybe it will. I guess it's money moving into value and away from growth. But when that ends, and when these sorts of numbers start playing out, now this is a future, but as I mentioned before, I think this Uber example and Tesla with Hertz is really important in terms of this concept of marginal demand and marginal demand destruction. So I will end there. Lots of innovation has already taken place. We are not just ready for prime time, we have entered prime time. The next 5 to 10 years are going to be magnificent. And we believe that truth will win out in the stock market. As far as we're concerned, innovation today is being treated like value was in the late 90s. And we know how that ended. We believe that innovation will win. And our research buttresses that conclusion. So please check out our website at arc-invest.com for some of our research. Next week, we'll get a lot of news in the multi-omics space. Both Simon Barnett and Ali Ehrman, two of our three biotech or multi-omics or omics analysts, we're trying to figure out the right way to say that, will be there. Simon just published Exact Sciences, his model on GitHub, and you can see how different our conclusions are relative to the consensus on Exact Sciences. Consensus seems to dismiss Exact as nothing but a Cologuard play. Couldn't be further from the truth. And I mentioned our Bitcoin Monthly will be out early next week. And then later this month, we will be publishing Big Ideas 2023. And you will see how much the preparation during since the tech and telecom bust, the preparation or the germination of the seeds that were planted in the 20 years that ended in the tech and telecom bust, that is now yielding fruit, real tangible fruit. And you'll see where we expect it to go during the next 5 to 10 years. And it's all very exciting. So thank you for listening. Truth will win out. And I'll look forward to doing this video again next month.